interesting
drastically slowing down purchasing billions of dollars or hundreds of billions of dollars of debt every month with printed money.
If there's too many dollars chasing the same goods and services, the only kind of way to tamp that down is to limit people's access to dollars, right?
I was reading an article about 2 weeks ago that basically said to take out a mortgage today, it's almost 40% higher than it was a year ago that day.
People have to be prepared and realistic. If someone's not realistic in their search, then we've got to be realistic with them and letting them know their approach is potentially going to be futile in this market.
Welcome back, Novello Nation, to another episode of the Aaron Novello podcast. We have with us some awesome human beings, absolute rock stars in the lending game here locally where we do business. They're our lender of choice. They are branch partners, brothers, right? And also responsible for 370 plus mortgages a year, $125 million of money lent. The one and only dynamic duo, Mr. Danny and Ari Tokar. Really appreciate you guys taking the time to be with me here today.
Thanks, Aaron. Appreciate you having us.
Thanks for having us.
Yeah, my pleasure. So, I think that this is on people's minds right now, and that's why I wanted to have us on and having this conversation together because, the game has changed pretty quickly. And we've seen interest rates kind of rise dramatically in a very short period of time. So perhaps before we get to that piece, talk to us a little bit about your guys' evolution, like how you came to mortgages and how you came to, being branch partners with your current, organization, Benchmark Mortgage.
Sure. So, yeah, I'll start. And again, thanks again for having us on. So when I started in the mortgage world, it was 2013. I was in the process of buying my home at that time. And some things that happened at the end of the process, I was buying a condo, some things that happened at the end of the process that caught me by surprise. And at the time, my loan officer, I had inquired it within, about potentially coming into the business and learning how to do mortgages and kind of teach people the way and kind of take the surprise element out of the end of the process. So I came in the business in 2013. I worked as a production partner under my mentor for close to 7 or 8 years. During that time, for the first year I was a production partner. I set up all of their loans and another loan officer's loans, took, and learned the business really intricately, took files from start to finish and really just, worked on the qualification end of things. Didn't really handle too much of the consumer conversation end of things, but really took the time to become a student of the game and learn what I was doing, learn how to, there's 9,000 different ways to do mortgages. So really learned how to become an expert and work within the guidelines to be able to leverage different ways to do loans. After my first year, I decided to become a loan officer, and I very quickly, with the knowledge that I've gained over that previous year, very quickly kind of blew up, for lack of better words. I think I did about $34.5 million of volume my first year producing. And at that time, I wouldn't have considered myself an expert. It was more so just from the, the hard work that I had put in and the effort that I was putting out there on the street to try to go and earn opportunities. At that point, I started to grow my team. Ari, I believe, was my second or third hire. I really needed someone that I've known for a long time and I can trust, intricately to be able to help, take us to that next level. And we quickly, grew our volume from 70 million, then 100 plus, year on. So the third year in of us originating, we're doing about 100 million in volume at that point. We weren't officially partners or anything like that, although we did work together and work all on the same pipeline, and we kind of worked under the same umbrella. But, we weren't, we were just kind of a team in a branch at that point. It wasn't until about two years ago, a little bit over 2 years ago, right before COVID started, that we had an opportunity with Benchmark to really grow their local market. They've been around for almost 30 years at that point, not been in the Florida market. We had a couple mutual connections within the organization that we were able to connect with and really sit down and just, kind of hear what they were about and how they operated. And it really struck a chord with us both. And, it was an opportunity in our career where we were able to kind of take the what we have done for the previous, I think at that time it was 4 or 5 years together. But for me, I'm sorry, 3 or 4 years together. And for me, it was like 6 or 7, 6 years in the business in total. It really gave me the opportunity to, kind of grow something beyond my business or my origination business and kind of run a branch and be able to help others do what I was able to accomplish in my first, 5, 6, 7 years of my career. Together we, really make a great team. I mean, there's a lot of things that both of us do well, and, we balance each other very well in the sense of, he really handles a lot of the operation stuff. Yeah, I handle a lot of the production stuff, and we both kind of know each side of the business, but it's really just where our brains go and what we really enjoy doing together, and separately for that matter. Being with Benchmark, it's really been not just being originators. We're running a business as well, and we have other loan officers and other employees that we're responsible for beyond us. So it's really been awesome. It's been a great challenge. We've been loving every minute of it. And Ari, anything you want to add on to there?
Yeah, just like Danny said, from the standpoint of Benchmark, gave us a chance to kind of like spread our wings a little bit and do more than just originate. And beyond that, that's certainly come. We've been, our focus has been equally on continuing to grow and refine our own production, and how we serve our partners, but also to be able to bring some other people into the business. And there's not a lot of people out there in the mortgage space that will take a chance on someone without experience. It's something that, Danny and I both recognize that we both got an opportunity in this business at some point because someone took a chance on us without that experience. And, we really we want to pay that forward. So it hasn't, we've had the opportunity to bring some people on and really kind of like coach them and mentor them and bring them through our system, hopefully have them learn from our experiences and not necessarily, go through all the pain that we went through at times and trying to figure it out, because we figured some stuff out over the years. And like I said, hopefully, grow some production and some great partners and outside of just Danny and I.
That's awesome. Yeah. And people will definitely benefit, from being in your guys' proximity. And that's cool that, from kind of a internal standpoint, that your goal and objective is to help others. Now, I'm curious, Danny, because I know it sounds like Ari's been doing this for a little bit less than you, again, a good amount of time, but a little bit less time. So talk a little bit about the environment in the marketplace and with interest rates when you first got started. So like what was happening at that slice in time in the market?
Yeah, so when my first few loans that I originated, rates were right around 4.7, 4.8, just creeping up there, and quickly fell after that. I had a long period of rates being somewhere hovering around, in a best case scenario, 2.6 and to about 3.25, 3.3 for a very long period of time. I would tell you right before COVID, rates started to creep back up. They had hit that high 4s, low 5s range, and everybody in the world was saying, okay, here it is. This is way overdue. Rates are going to start going back up, and the days of low rates are gone. And then obviously COVID happened. The world shut down. Life changed, domestically and internationally, basically overnight. Things kind of just came to a screeching halt for a while. Not that long of a while, but long enough for it to be concerning. There were some shifts in the financial market that caused our government to step in and basically, for lack of better words, write a blank check for mortgage-backed securities, which really drove rates down, drove it down fast, and created an extraordinarily volatile environment for quite a while. But ultimately, the end game was rates fell, and they fell to a point where they had hit the lowest level in history, or very, very, very close to it. They stayed low for quite a while. The Fed kept purchasing, unlimited amounts of bonds for a long, long time.
Yeah, and I'm curious because I know you say that quickly, and I'm also aware that some people might not understand what we're talking about. So yeah. Why is it that when mortgage-backed securities are purchased, that rates, at basically an unlimited quantity, that'll keep rates low?
Yeah, I mean, the easy answer for that is that, you basically have an unlimited buyer of your product. So, you're creating a situation where, if the government's not just buying everything, then you have a private market for these bonds. And people compete, they're going to compete for the cost of the bonds. But the government's just out there just saying, we're going to keep buying them, buying them, buying them, buying them, buying them. So a lot of the private market went away or scaled back. And, the government just literally stroked a blank check, which ultimately drove the value of these bonds down. Up. It's an inverse chart. Sorry. But what happens is, when the government comes out and says, hey, we're not going to continue to purchase these or purchase these at the levels that we have been, all of a sudden you're waiting on private money to come back in and regulate that market and find where the value, or not the value, but where the cost that they're willing to pay for that coupon is. So, we've had over the last 6 months, 5 months, like almost 1,000, close 900 to 1,000 basis points sell off in bonds, because there's nobody there just unlimitedly buying them for the value that they're putting them out. I see you want to say something there.
Well, so what started as the government taking action because they needed to provide liquidity to the market, because had they not stepped in and said, yes, we're going to purchase mortgage-backed securities, there would literally be no market for mortgage-backed securities, which means no matter what happens, unless a bank was lending their own money, portfolio lending, like mortgages would have stopped. So the Fed came in and provided liquidity to the market. The Fed also kept, as Danny described, almost unlimited liquidity in the market for nearly 2 years. So what was, hey, let me step in and save, ultimately wound up contributing greatly to a little bit of a free-for-all in the mortgage market. And also that is part of what caused and contributed to the run-up in the real estate market, right? Super cheap money, super high demand, and ultimately in a time that still was encased with economic uncertainty throughout for many people. The beginning of COVID, once the initial craziness of all of the unemployment claims and layoffs and that sort of stuff happened, and then slowly clawed back to get us to where we're at right now. Ultimately, you look back 6 months when things started to take a turn, and what we experienced was an environment where there was no way out other than what we're experiencing right now. Rates were kept at an artificially low level for such a long time that the only way out was kind of the let's rip the Band-Aid off approach. And what happened was the Fed announced not only that, and this doesn't take into account any of the other external factors like wars or anything like that contributed, right? But the Fed basically said, we're going to stop buying. We're going to taper our buying of mortgage-backed securities, which is going to, in theory, bring the private market more into play, which the private market is going to have a higher expectation of returns, which means rates are going to be higher because the return on that investment has to be higher. And that happened in conjunction with major supply chain slowdowns, war in Europe, all these things, inflation that all of a sudden hit 6, 7, 8% month after month after month. And that's where we're at right now. Part of the reason that not only have rates run up very quickly over the last 3, 4, 5 months, and they're over 2% in almost every metric you want to look at, right? But part of the reason it's creating a little bit more pain for borrowers is that the people that do purchase, the companies that purchase the mortgage-backed securities are being very, very cautious right now, because what they want to avoid is lending money at higher interest rates and then have the risk of, or there is the risk of economic, let's say recession, that is going to then cause rates to drop again, which is going to cause another mass refinance boom, which is going to make all these people that are lending money at higher rates right now lose money because they got refinanced out of those loans. So what you're seeing is a combination of factors when not only are rates increasing, but rates are kind of like, again, I use the term artificial because it seems like it should be a little different, but we're making up for past, discretions of, past, mistakes, if you will. So now, even at the higher rates, it's costing borrowers more money to get those rates because the banks want the insurance that even if this thing gets refinanced in 6 months, 9 months, 12 months, whatever it is, that they're collecting a little more upfront to lessen the blow. So it's a very weird time. It's very volatile. and it's it's not everyone's favorite time to be trying to figure out what are the rates going to go up or down, or whether I should buy right now or whatever, because it's complicated, and rates are as high as they've been since 2009. So we've on a 13-year run of low interest rates, many times historically low through that point. It is just new. There's an entire generation of home buyers that have never experienced rates in the fives. Historically speaking, rates in the fives, great interest rate. Right now, rates in the five, sticker shocks for a lot of people. But as that normalizes, the sticker shock goes away, the market normalizes, and then that's just, hey, if that's the new normal, that's the new normal. And it'll just take a few more months for people to really kind of come to grips with that.
Yeah, that's awesome. I think both of you did a really good job kind of explaining that. I was taking notes. So, one is this kind of euphemism. It's a very interesting word to use, the word taper, because it sounds like it's like, oh, it's a little taper that's quiet, versus like, yo, we are stopping buying them, right? Which is like, we're done. So it's
we're drastically kind of slowing down purchasing billions of dollars or hundreds of billions of dollars of debt
month,
every month with printed money that we're printing in order to do so.
Yeah, so I love that choice.
A little scarier than taper.
Yeah, exactly. Yeah. So that's interesting. The other thing that I think is interesting that you mentioned was, inflation and the reading being 8%. What's very interesting is I know that number doesn't include housing or energy. So that's pretty fascinating, because if we did include housing and or energy, the question is, would it be 8%? And I would propose it would be much higher than that, right? So that's kind of interesting. And then the other thing that's interesting is this kind of limiting people's access to money, right? Because if there's too many dollars chasing the same goods and services, the only kind of way to tamp that down is to limit people's access to dollars, right? Which is kind of what's taking place. So I guess talk a little bit about how much that's impacted, because my hallucination is you had a bunch of buyers that were pre-approved 60 days ago, and then we look at their pre-approvals and they're like, hey, Ari, sorry, brother, you are no longer approved for that amount. We got to look for homes that are $100,000 less. So talk a little bit about like that and how that's like shaking out.
Yeah, so there's definitely the increase over the last 6 months has definitely, even the last 2 months has definitely lowered people's qualifications in combination with increasing the cost at the value. Like if it doesn't affect their qualification, if they're well qualified and they still want to buy that same house, it is now more expensive. I was reading an article about 2 weeks ago that basically said to take out a mortgage today, it's almost 40% higher than it was a year ago that day. And it was right at the end of April that I read that. And the reality is that, if you think about that, it's like, to buy that house last year, it was, from speaking about the mortgage and, just the principal and interest, it's now 40% higher than it was a year ago. Then you factor in some other elements like what we've experienced in the insurance market here in Florida. And that's really, driving people's prices up, and then ultimately, like you said, affects their qualification. So one thing that's super important is that, making sure that, as a realtor or a client, you're always out there staying in touch with your lender and whoever's helping you buy a property, and make sure you have up-to-date information. Make sure that you know what the market is right now, so that way there's no surprises for you. If you were shopping 2 months ago and now rates are half a point higher, and you need to know what that looks like on paper, whether you qualify or not. With that said, the banks are not increasing the guidelines for what they allow people to qualify for. So you are seeing people that are at the brink, if they're at the highest debt to income ratio that they're allowed to be at, that it might push them over, which then would require them to lower their purchase price, maybe pivot from looking at a condo that has an HOA with, a higher HOA to something that's more of a townhouse or a single family without an HOA, keeping in mind the insurance and tax variables. But either way, it is definitely hurt from a qualification standpoint and definitely slowed down the market. Your pool of buyers for that $600,000 house has just been reduced over the last couple months because of the rate increase from a qualification standpoint. So for every, if you had 10 buyers that qualify for that house 2 months ago, you might have 8 or 7 that qualify for that house now. So that is where you're starting to see it. And I think, Aaron, you may be able to help me or, correct me if I'm wrong, but you're starting to see that a little bit on the amount of offers per property, maybe not days on market, but the amount of offers on property you know, starting to be limited as, you know, in that last really 30 days, you know, so much. As far as dollars and cents wise are, you want to talk about just more specifically percentages on how, you know, going up percents, what that does to your qualification?
Yeah. So like in preparation for our call today, I said, let's look at a typical loan amount, you know, a $500,000 mortgage, right? Which in South Florida is not an unreasonable mortgage amount, right? And so like going from looking over the last, you know, say go back 6 months, and let's just say we're looking at a rate of 3.5 versus 5.5. Well, if you're talking about dollars and cents for a borrower, it's a difference of almost $600 per month in just principal and interest. So like there's a tangible element to that. You know, you take a principal and interest payment that goes from $22.45 to $28.39 with the 2% increase in interest rate, right? Then to what Danny was saying too, well, you know, part of what we do is our process is it's not just what do you qualify for, you know, but there's a lot more questions that go into it. And what can you afford is the most important, is one of the most important ones there. There's a big difference between, for some people, what can you afford and what can you qualify for? And under normal markets, if you have a client that says, well, you know, my comfort level, I can afford $2,500 a month. And we say, okay, well, perfect. You can qualify for $3,500 a month. So you're in great shape because you're going to be able to purchase something that you can afford, and it's well within the parameters of what you qualify for. In the market over the last couple of years, there have been times where some clients that relationship is a little bit, you know, inverse. Someone might want $2,500 per month, but they might only qualify for $2,200. And then it's like, okay, well, what changes? Because there's only a couple of things that can change. It's either change your search parameters, find more income, which could mean a co-borrower, could mean a couple different things, get rid of some debt. There's different ways that you can, you know, help someone qualify for more. But again, that balance between afford and qualify are kind of important. So if you're talking about a borrower that is, let's just say, very well qualified and isn't going to have an issue qualifying for the payment, it is then just a question of it's going to cost you more for that same house at the same interest rate, right? On the flip side, if you're talking about the borrower, what Danny alluded to, someone that's pretty close to maxed out on their qualification, right? They might have been in a $400,000 or $500,000 price range, and all of a sudden, their maximum might be $300,000 to $400,000. $600 a month in payment is the equivalent of, by most estimations, somewhere between $100,000 and $120,000 in purchase price, right? So if someone was qualified for, let's say, $550,000, now all of a sudden they might be qualified for $450,000 with the exact same parameters. At the same time, prices are going up, and that's where you're seeing, you know, that's where you're seeing those challenging conversations with your clients and with our partners too, in saying, okay, we've got to change gears here a little bit, right? Like the $550,000 house that you wanted, well, one, you might not be able to qualify for it anymore. So like, let's change gears, and how do we either get you into that house, or how do we change your search parameters so you can get into a house? Because it's possible that the less expensive house might continue to appreciate in value too, and someone winds up priced out of that as well if they don't change gears. And we do take a very proactive approach in our you know, conversations with our clients. You know, Aaron, you said it. We've got buyers that are kind of stacked up on the sidelines, like waiting for inventory or waiting to find the perfect spot. And you know, we have 100 people right now that would want to buy a house. If you walk in and pick it off the shelf and do it, they'd be ready, right? But the reality is the market isn't, the inventory isn't there for that yet. It's starting to tick up. I think we're starting to see probably this last month, the first time where you've got some like positive inventory movement month over month. But yeah, no, I mean, even our pre-approved buyers, if they're actively shopping, we're in communication with them at least once a week to get a feel for where they're at and what they're doing, and you know, how we might be able to help. And you know, sometimes we've seen it. You've seen people drop out of the market. You've seen people, you know, go take a break, have to renew a lease or whatever it is. You know, but we're doing everything we can to help them, you know, kind of achieve that goal of purchasing a home, and to, you know, I don't want to say get creative in doing it, but you know, do everything that we can to help strengthen an offer to compete in a super duper competitive market, right?
Yeah. Hey, and creativity is not a bad word, bro. It's good. So what I'm aware of is, as I'm taking notes as we're speaking, and yes, what I've seen is I think inventory went up by 5%. It's the first time that's happened in like the last 12 months in this geographic area, which would make sense as demand, begins to soften for the reasons we're describing. I think it's also interesting for everybody that's out there listening that, the change in rates is the equivalent of a $600 a month change in payment swing, and that's the equivalent of $100,000 to $120,000 in purchasing power. And that's pretty interesting. Also, this concept that everything on the market has become more expensive without the prices changing because the cost of money is more. And that's an interesting observation and awareness. And then when you said afford versus qualify, like that's interesting to me because I'm imagining, right, that over the last 24 months, hadn't really had to have too many of those types of conversations. I know you guys are the type of folks that you always do because you look out for people's best interest. At the same time, I'm aware you haven't had to be, really kind of hawks as far as that is concerned. And I'm imagining that now this is why it's so important that if you do engage, with someone, if you are interested in purchasing, that they would have that conversation with you. Because I know it's a difficult one. It's an uncomfortable one to tell somebody like, I'm aware that when we're accustomed to getting whatever we want it right now. Like, hey, you're going to have to wait, or hey, like, this is not, it's not going to look exactly the way you wanted. We're going to have to maybe do something different or do a stepping stone. And like the professionals have to have the intestinal fortitude to have those types of conversations. Is that right?
Yeah, and it's never easy to have a conversation with someone telling them something they don't want to hear. With that said, it's important. Our job is to educate people and provide them value in our expertise and be able to help lead them to where they want to go. And that doesn't always work today. But if you put, if you got a bunch of great people that put their heads together, we can get there. So, sometimes you have to have that unfortunate conversation. And at the end of the day, listen, when I went to buy my first house, I thought I was going to get this single family, and my realtor at the time was showing me these $300,000 houses in Coral Springs, and I could afford 170 grand. And ultimately, like, I had to have like a real come to earth moment. Like, okay, as much as I want to move into that beautiful home in Coral Springs, like I can afford 170 grand. And you know what? My next home that I bought after that is the beautiful home that I wanted. And it's just like I experienced that myself, and I think that kind of gives me some insight on, some of these first-time home buyers that we're working with, going through it themselves. But it's always important, and that's part of like what Ari's saying is like not just about what people qualify, what can you afford. It's about giving people a plan for what works for them. So and sometimes that's today, and like Ari said, sometimes that means they got to re-sign a lease, and that's next year or 6 months down the road. But regardless of what it is, we're going to do that. While I was talking real quick, I was able to pull up some data just to go back to the rate conversation real quick. So as I told you, like right before COVID, rates started to spike up a little bit, and then COVID happened. So I was just able to pull this information from the New York Fed's database that, right before COVID, for the year and a half, couple years before COVID, the Fed was buying about between 20 and 25 billion with a B in mortgage-backed securities a month, up until about February of 2018. In February 2018, they reduced those purchases anywhere between, on the lower end, 5 billion, and the higher end, 12 billion. But for the next 6 months, they started reducing those purchases to all the way down to about 5.5 billion. That was back towards September of 2018. Then here's where it gets interesting on our side. After that, it was 300 million, 300 million, 300 million, 300 million, month after month after month after month. Well, what started happening is rates started going up, and then we got to COVID. As soon as COVID hit, Fed comes out and says, hey, we're going to start buying mortgage-backed securities, right? Ari said to stabilize the market and provide liquidity to all the places that needed it. And that 200 to 300 million immediately from 1 month to the next jumped up to 3 billion plus from there on out. And then 3 billion turned into 6 billion, turned into 9 billion, all the way up to June of 2020, they were purchasing $96 billion of mortgage-backed securities per month, then 100, then 110, and then 111. So you see that was what was driving your rates down. So just from December to January, they decreased the purchases of mortgage-backed securities by 75% overnight. And that's kind of what's been happening. Right now, it's at about 34 billion a month. So we're still at like back to pre-COVID levels, but not quite so much what you've seen the last 12 months, the last 18 months since COVID started.
That's interesting. And based on what you're sharing with me, then my understanding is as they back the purchases down, then it goes to, kind of the open market. And the open market investors want to be compensated more for risk. They're not just going to blindly buy everything. So when they want to be more compensated for risk, then there has to be a higher rate of return.
Well, when you have an investor that wants to, that wants the rate of return, and they're investing their own money, or they're investing their shareholders' money, or whatever it is, they have higher expectations than when the government is literally just printing money for the sole purpose of buying mortgage-backed securities and has really no expectation of return on investment, figuring at some point we'll clear out our balance sheet, we'll sell these loans, but it's not an investment. It was a liquidity play on the government side, in fairness, to keep the mortgage market moving. But yes, when there is an expectation in return from the Wall Street side of things, it's higher than what the government stepped in and did.
Yeah, I think that's wild. I think I read somewhere if they would have kept up at that pace, that the government would have essentially owned like 70% of all homes in the United States based on owning the kind of mortgages sort of thing. So, okay. So then here's my question to you guys is, like, moving forward, we see all of these things happening. Clearly you guys understand it very well. You understand the way the machine works very well. So moving forward, nobody has a crystal ball, myself included. At the same time, having seen what we've seen, knowing that inflation is still at a very high rate, what's the probability that moving forward we'll continue to see kind of movement in an upward trajectory as far as rates are concerned?
I mean, I think ultimately, I don't think we've hit the top. I mean, it all depends on what you're reading, where you're reading it, and that kind of stuff. But I mean, this is my personal opinion. We've had such a sharp increase so fast that I think we will see a period of consolidation. Now, how long that period is, I don't know. And that's where, our crystal ball would be great. It's the, billion-dollar question there. But the reality is, I do think you're going to see a stretch that rates are going to bounce in this range of where they're at right now and not continue to exponentially go up. With that said, every time a set of inflation numbers comes out and it's higher than we expect, or not than expected or whatever, as long as it's still high, there's still the likelihood that they could continue to push this narrative and continue to artificially, hey, we're going to raise the Fed rate another 50 basis points. Now, another 75 basis points. Now, that doesn't have a direct correlation on interest rates, and I'll let Ari explain that a little bit. But the reality is that it's a perception, and then people hear it, and then the media takes it, and then it drives fear in the market, where the prime rate that the Fed sets is not a direct correlation on what your rate is that you're getting. That is driven by the buying and the selling of mortgage-backed securities. So, like I said, I do believe that we're still going to see them go up. I mean, I've heard from various places that maybe we get up to the 8-9% range. I do also agree with what Ari was saying earlier, that at some point, if the economic outlook in our country doesn't change, we are at some point going to hit a recession. And then when that happens, they will artificially drive them back down. So I think that's where the next few weeks, months really are going to be important to see. Do we get more private money in there, or does everybody kind of sit on the sidelines and wait to see what happens with our economy? And is the Fed going to come and step back in and give it to them cheaper? So
unfortunately, we have going on almost 20 years of questionable monetary and fiscal policy, that is not easy to just unravel in a day and say, okay, we're going to get it back to normal, right? Because like I said, we have a generation of borrowers, a generation of citizens, of U.S. residents that are just used to things working in a certain way, and it's challenging to just hit the reset button. But there is an element or some elements of our system where the reset button is kind of what's needed, and at whatever point when it when it's hit, or an aspect of it is hit, you get this kind of cause and effect reaction. And that's what causes volatility. And again, I do believe we will get stability to the market, even if that means a sustained increase in interest rates. a slow and sustained increase in interest rates is still stability. What we've experienced over the last 5 to 6 months is a very, very rapid increase in interest rates, and there's nothing stable about it. So it's volatile on a day-to-day basis, and it's volatile on a long-term basis because I don't think we've ever seen, certainly not in our lifetime or time in the business, when rates have gone from 3 to 5.5, or 3.5 to 5.75 or whatever, when we've seen this much movement this quickly. And that is kind of the inherently in unstable element to it. But if we go back to say 2019, the projections were that rates were going to probably increase about 1% over the course of the year. Is 1% a lot? Yeah, but 1% over 12 months, when it kind of follows a slow and steady approach, isn't earth-shattering. What we're experiencing now for many people is earth-shattering, and that's the difference. Is because, not to say no one predicted it or no one expected it, but I can tell you, not everyone did, and
or as fast as it happened.
Right. That's people in the mortgage industry. That's people in the real estate industry. That's certainly borrowers. And that is, and at the same time, that's also our government as well, who, like I said, planned on tapering, going back to that word, but not necessarily tapering in conjunction with a war and major supply chain issues and inflation and in an environment where rates were going to increase so quickly. And tapering was going to exacerbate that problem.
Yes, 100%. So I wrote down a couple things, as you guys were talking, is the volatility is what creates a change in consumer sentiment. I mean, that would be my kind of my input on that, right? So where people start to think hey, what's going on, and it causes them to kind of pull back a little bit. And then to your point, I think the rates have gone up faster than they have in the last 30 years, the speed with which they went up, in a short amount of time. So here's the question then, is if somebody's a buyer out there and they want to purchase, right? In an environment that we're in right now, I think homeownership is a good idea, right? And if you have a compelling reason to purchase, you should. For most people, it's the primary vehicle for wealth accumulation. The majority of Americans have the majority of the net worth tied up into their house. So it's a mechanism for acquiring that. So I guess my question to you guys would be is, as buyers in the marketplace, what would be your blueprint? What would be your formula? Obviously, first, call you. Right. But number two, what's the blueprint? What do you think people have to be prepared for, not only psychologically, but practically?
I think one of the things that we do is we do a lot of work up front, right? We do a lot of work up front to make sure that the person that we're, saying, Aaron, your client is pre-approved and they're ready to buy a house, to make sure that their loan doesn't fall apart, right? So we do our research on that side of things too. But we really do. We take time to go over their options, to go over their parameters, to help them understand what A looks like, B looks like, C looks like, and make sure that no one is wasting their time. I think your question, I wrote it down when you said it, is that, the compelling reason to purchase. When someone says, is it a good time to buy real estate? I always say, it doesn't matter what the market is. It's a personal question. It's not a macro question, it's a micro question, right? What are your goals? What are your needs? What is your comfort level? What is your, level of risk tolerance or aversion? And let's sit down and figure that together. And then I think in today's market, if we get through that checklist and we have the client that is ready to purchase, right? Then it's a question of, okay, here's what you have to prepare yourself for. And this is where we work together with our partners too, because it makes sense. You've got to be decisive. You've got to be aggressive. You've got to be, you've got to put your best foot forward. And at the end of the day, you have to be a little bit kind of steely, right? You've got to be willing or understand that you might deal with some disappointment in this market, because there's a dozen other people that feel exactly the same way that you do that are gonna make an offer in that same house that you love. And there's a time, and it's so funny because I go back to say 2.5 years ago, right? And if a client said, what do I have to do to get this house? My answer would be, listen, I'm not the real estate professional, but I'm well, pay them what they're asking for it. You'll probably get it. 90%, you're going to get it, right? And that notion right now of just give them full price is a skewed notion right now. So it can't last forever, but there's people have to be prepared and realistic. If someone's not realistic in their search, then we've got to be realistic with them and letting them know that their approach is potentially going to be futile in this market.
Yeah, and just to tie in a little bit to what Ari was saying, about preparing them. We know what's happening in the market, that we might experience that there might be an appraisal gap, or they might have to waive the appraisal contingency. So it's our job up front when they're going to make an offer to call you, Aaron, and say, hey, Aaron, do you think that there's going to be any appraisal issues on this house? If so, roughly, how much do you think it's going to come in and appraise at? And then what that allows us to do on the front end of the process is prepare the customer. If we know that they're buying a $600,000 house that the last place in the neighborhood closed at $550 and there's nothing supporting above $550, it's important that we understand that and educate the customer up front so they know if the property were to come in at $550, well, what does that look like on paper? Well, maybe that customer's putting 20% down and now they can put 10% down and it doesn't change things too dramatically. Maybe they've got the extra cash to come out of pocket and just pay the difference. But it's important that they know that before they're making the offer, because once they make the offer, go under contract, pay for an inspection, pay for an appraisal, well, now they've already spent time, which is money, and they've spent money, which is money, and they might come to a result that's unfavorable, which then tarnishes you, tarnishes us, and tarnishes everybody in between, because we could have educated them up front and given them the ability to understand that. So that's part of what goes into our process up front with our clients and our agents to make sure that the customer is prepared, no matter how many properties they've bought in their life, that they're prepared for this market environment, no matter what comes at them.
Yeah, I love that. So I wrote down a few things. One is a realistic time horizon. It is not normal that you own a property for 1 or 2 years and sell it and make money. So you should have a realistic time horizon that you may have to hold on to it for 7 to 10 years, recognizing that a house is a place to live, first and foremost. And then, if you get ancillary benefits from a financial perspective, cool. The second thing I wrote down is you have to have a compelling reason, like a very specific, compelling reason to be in this market, because what I'm aware of is, to your point, is you're going to have to deal with friction. And in order to deal with friction, you have to have a compelling, motivated reason, right? Otherwise, you might not be willing to do that. Two is you got to come guns blazing, right? Particularly if you're trying to make offers then at affordable range. In our marketplace, that's between like 300 and 500. There's no real kind of negotiating. You got to make very aggressive offers with very aggressive terms and conditions. You're not entitled to a counter. Don't imagine that you are, right? So you got to put your best foot forward right out of the gate. And then three, really being upfront with expectations, not only on your end, as far as what the money's going to look like and payments and all that other stuff, but also on our end, as agents, educating them on, okay, here's realistically what you can expect. So that way there's no surprises kind of moving forward. Now, what I'm also taking from this conversation is for those people out there that are thinking about selling, what I'm aware of is that there's two emotions that dominate any market. One is greed and the other one's fear. And what I've personally seen in the marketplace is that first one come roaring and raging, right, over the last 12 months. And I think consumers, it takes them a while. Last time, because I was selling real estate in 2008 and 9, and it took about 12 months for sellers to recognize oh, this is like a different environment. And what I'm aware of is like that affordable price point. I'm not seeing it there as much, but I am seeing it in the higher ones where you're not getting 10 or 12 offers, you're getting 1 or 2. And you're not seeing as aggressive terms and conditions. So the other thing I'm kind of sensing from you guys, that if people have been sitting on the fence like, oh, I'm going to wait and see what happens, that if they want to sell, they should probably do that. Is that right?
Listen, as long as they've got a plan, right, and that's the key, and that's what goes in. Yeah, because they are sitting on a ton of equity, and if they've bought any time within, really since 2010,
yep.
They're sitting on a huge stack of equity that they can then turn around and leverage into one of many things. Whether that's a primary with an investment or a second home attached to that, not physically attached, but in general, or just be able to help change their financial outlook. Listen, I'm a big believer. It's always a good time to buy or sell. When you're renting, you're paying 100% interest rate. You're paying somebody else's mortgage. So if you've got someone sitting on a high equity position, there's a lot of different things that they can do with that.
And I think, Aaron, you were talking about the the affordable range, right? Which we know that range always moves, but Danny and I, one of the things that we kind of getting back to like our passion for helping people, right? And we've always kind of felt that like our core of our business is going to be working with the clients and working in the price range for the homes that people need, not necessarily the homes that people want, right? And so what you just described is exactly that. Like there's still unrelenting demand for the homes that people need, right? Which is what keeps the, I don't want to say the bottom part of the market, but the the lower priced part of the market, regardless of what that is, very, very strong, because there's always someone looking for their first house. There's always someone looking for the step up as the family grows. There's always someone moving to the area, graduated school, moving back to where they can, and looking for that opportunity. Where you tend to see the market soften a little bit first. And I think this has been, even back in 2018 and 2019, when rates started to increase a little bit, is that I want that big house side of the market, but I don't need that big house side of the market. Because if someone has a house that serves their family, they just want something a little bigger and nicer, it becomes a little bit more, it's more disposable income, right? So that's where you start to see it soften first. I think that's where we're seeing it a little bit. But even still, a listing in that luxury or a high-end price range that's getting even 1 or 2 offers on the first weekend, typically at or near full price, is still a pretty strong market, right? So it's just not what it necessarily was 6 months ago or 12 months ago.
Yeah, 100%. And I'm in agreement with that. I think over the last 2 years, people just got spoiled with a certain environment in which they could buy whatever they wanted and sell for whatever they want. And now we just have a reality coming back into the market.
Just have an adjustment period.
Just an adjustment period.
I think
that was a very politically correct way. Danny said, we have an adjustment period, ladies and gentlemen.
So the people that are thinking about selling, again, it comes down to why are you thinking about selling and time horizon and all of those sort of things too, right? There could be like, there could be a scenario where someone's got a ton of equity and maybe they're a couple of years from retirement and it makes sense to get more conservative and stabilize their investments and pull that, and do that now at a time where maybe markets are kind of nearing a high. But there's always a reason. It's all situational. There's always a reason that people want to buy. There's always a reason that people want to sell. And it's when you have kind of the extremes of the market, like we've experienced over the last couple of years, where it brings other people into it.
Yeah, I think that's well put. And, a question that I always lead with is, my job's to help you. It's never to talk you into doing anything. So just so I'm clear, was there any specific reason or purpose that you either wanted to buy or sell? So that way, we can guide appropriately. So listen, guys, this has been really educational. I think people are going to get a lot of value from it. I appreciate, again, you taking the time. So if people want to find you, if they want to ask you questions, if they want to talk to you about mortgages, things of that nature, where can they find you? What's the best place for them to get in contact with you?
We typically give out our cell phones for everybody, so they can call us directly on our phone. They can find us on Facebook, or we can also send out our email address. But my phone number is for anybody that has any questions, whether it's relating to buying, selling, refinancing, or just have some regular mortgage related questions that they want to go over, financial related questions. My number is 954-589-3661. That's my direct line. Ari, you want to go ahead and give your contact information out?
Yeah, sure. Mine's 561-714-4218. And geographically, although, we kind of described at the beginning, we work together. We have everything. Danny's in Broward County. I'm in Palm Beach County. We have offices in both places. We like the opportunity to meet face to face more than we did over the last couple of years too. It's nice to actually get to talk to people. So yeah, our Ari.Tokar at benchmark.us, Danny.Tokar at benchmark.us, or give us a call on our cell, and we are both happy to help.
Perfect. And those are the kind of guys they are. You get their direct cell phones. That's not the case with, when you're dealing with the partners in the organization. And I can attest to the fact that they'll pick up the phone whenever I call them. They pick up the phone immediately. So if you guys have enjoyed this episode of the podcast, be sure to smash the subscribe button. If you think somebody else could get value from it, just go ahead and share it. And we look forward to connecting on the next episode. I really appreciate you guys taking the time. Look forward to connecting soon, okay?
Thanks, Aaron. Appreciate you having us.
Aaron.
My pleasure.